What is going on, y'all? This is Pay Me in Dividends, and today is April 7th, 2025. All right, we're going to jump right into this video and we're going to look at the S&P 500. So the S&P 500 did open down. It's down, it's trading about flat, but as we know, the S&P is down almost 10% over the past 5 days and 14.5% year to date. This is insane. However, there is opportunity in the market. All right, there is opportunity inside of the market, and I want to show you guys exactly how you can capitalize off of this. Now, this isn't necessarily financial advice, but listen, I'm gonna be honest with you guys. The market is gonna recover. All right, and I'm gonna show you two ETFs that you can actually invest into, where you'll have a very, very good chance of uh making money in the long term and building that long-term wealth that everybody talks about. The difference is people use this phrase when the market is positive. However, when the market crashes, many of those same people panic and either sell their investments or they completely stop investing their money into the market and they call the market a scam. And so, I'm going to show you guys a couple ETFs that you can put your money into, and you can buy these assets at a discounted price without having to necessarily pick an individual company. And I'm going to show you right here. All right. So the first one I'm going to show you guys is SPLG, and this is actually an ETF that I'm buying at the moment right now. And basically what it is it tracks the S&P 500. The S&P 500, for those of you who don't know, are the largest 500 companies in the US. They are interchangeable. So if a company is not performing or not meeting the criteria of the S&P 500, it is replaced periodically. So putting your money into this gives you that automatic diversification, and it avoids you having to pick an individual company. All right. Because the thing is, the market is going to rebound, but we don't know when the market is going to rebound. And I want to show you guys a couple things. The first thing I want to show you guys is Warren Buffett, and this is actually a famous bet uh, that he made with some hedge fund managers, where he bet that an S&P 500 index fund would outperform a basket of hedge funds over a 10-year period. So what does that mean? He basically bet that the S&P 500, the entire market itself, or a majority of the US market, would outperform so-called professional investors or advisors or hedge fund managers. They were able to pick the exact companies that they want to invest into, and Warren Buffett bet that the market itself would outperform over the long term. And of course, needless to say, the S&P 500 outperformed. So you can actually see here, Fund A, Fund B, right, so on and so forth. You can see that the index fund that simply tracked the S&P 500 outperformed over a 10-year period. And if we zoom out, we can see that the market always recovers. So this is where we are right here. All right. So today is April 7th. You can see this dip. You can see where the market kind of peaked around November, December, going into January of 2025. And then bam, it dipped hard. And this is where the opportunity is, y'all. This is where the opportunity is. I want to show you guys another graph. So this right here is a visual representation of how much a dollar would increase in value since 1870 in the stock market. And you guys will notice here, right? So 1929, you see the Great Depression, you see World War II. Over here, a little more recent, you see the pandemic, 2020 through 2022. And here we are now. This graph kind of goes until January of 2025. And then, of course, we had that dip right after. But you can see this is a visual representation of all of the times that the market has taken massive dips, but it has always recovered. And so basically, when you put your money into the S&P 500, you are betting on the entire US market instead of investing in an individual company. So it's just one way to invest. I'm not against investing in an individual company, but I think this video is geared more towards people who are just starting. And I think this is a great time to put your money in the market. And even people who are already invested, I think these are good opportunities. So again, the first one is SPLG, which tracks the S&P 500. And then the second one is QQQ, which tracks the Nasdaq 100. And the Nasdaq 100 is more tech heavy. There's less companies, less diversification than the S&P 500, but there's still a lot of good companies in there. Just think of all the big tech companies, Nvidia, Microsoft, Google, Apple, so on and so forth. So all of those companies are in the Nasdaq. There is a lot of overlap in the Nasdaq and the S&P 500, but I think your money is safe in either one of these big indexes. Again, over the long term, you got to have a long-term mindset when it comes to investing. Now, another two ETFs that I want to put you guys on is the first one is SPY from Neos. And this one is very similar to SPLG, except the difference here is that you're sacrificing some of the long-term growth in order to receive dividend income. So this one actually performs options on their portfolio, and they're able to generate dividend income, about 12% yield annualized, and they pay out every single month. But what I like about SPY is that they actually own the company shares of the companies within their portfolio, and then they're performing options on their portfolio to generate that income. I hope that makes sense. Again, to some of you, you newer investors, but this is a good income fund. And then, of course, QQQI, which is pretty self-explanatory. It's based off of the Nasdaq, and it has the same exact strategy as SPY, except it is based off of the Nasdaq 100. And this one is actually one that I'm invested into, and I'm going to continue buying shares during this time. But really, I think the point of this video right here is just to let you guys know that the market always recovers. The market always recovers. You know, remember what Warren Buffett said: be fearful when others are greedy, and greedy only when others are fearful. And I think that's a very, very good reminder to not get too emotional during these times. Just remember that the market is always going to recover long term, and look at this as an opportunity. You do not want to look back a year or 2, 3 years from now and say, man, I could have bought some really, really good assets during this big dip here, and now the market is overpriced again. All right. Now, you should always be investing, you should always be dollar cost averaging. But these times right here on these big dips are when you can really, really load up. And of course, it's going to be different for everybody. It can be $100 a week. It can be $500 a week. It can be $20 a week, whatever it is that you can afford. But the point is putting money into your brokerage account and putting it into good assets that will appreciate over time. And right now, the market is on a discount. So you guys let me know in the comments, what are y'all invested in? Are you going in on the index, S&P 500, Nasdaq 100? Are you buying up dividend stocks? Are you buying up individual companies? You guys let me know in the comments. As always, I appreciate you stopping by the channel, and I will catch you in the next video.